Hello, traders, and welcome to this very special live stream. Today is the day Fed, FOMC, and Powell speech. Let's get ready because anything can happen. And there is, as always, with me, Dimitro. Hello, Dimitro. How are you doing?
Hello, Rafa. I'm doing good. And yes, over the past few days, the market have been a mess of nerves. First, pricing in a rate cut, then no, then yes again. And today, we'll finally get the truth.
Oh, yeah. Hello, J Doc. Hello,
Hi,
Soda.
everyone,
Hello.
guys. Hello. Yeah, very
Hi,
important
everyone.
stream today.
Yeah, everyone was waiting for today since the market is quite flat. So let's see what's gonna happen. The Fed situation is extremely complex. They are stuck in a limbo with no exit, Dimitro.
Yeah, exactly. So on one side, the labor market is showing signs of weakening, and actually that's very dangerous. But on the other side, inflation remains stubborn, so still above the famous 2% target.
Correct, exactly. And this creates the perfect dilemma. If they cut rates, they risk slowing down the drop in inflation. But if they don't cut, they worsen the labor market and, even more importantly, the overall system liquidity.
Yes, that's right. And actually, in fact, when it comes to liquidity, we have already seen structural cracks in a banking system. So keeping rates this high for too long, yeah, risk grinding everything to a halt. So
Oh,
what do you
yeah.
think about what do you think about market expectation, Rafa?
Yeah, let's show the Fed watch.
Yeah.
At the moment, the market consensus is extremely strong, as we can see about 90% believe in a 25 basis point cut.
Yes, but we know very well that when it comes to the Fed, actually nothing is guaranteed. I mean, it's like immediate market reaction that matters, and then obviously, yeah, the Powell,
Yeah, yeah.
he's the one.
Obviously, Powell brings
Yeah,
some
yeah.
chaos.
So
So,
yeah,
guys, yeah,
yeah, guys, tell us in the chat if Powell will be hawkish or dovish, and Rafa, tell us what does it mean hawkish or dovish?
yeah. Oakish, of course, no rate cuts, and dovish,
Yeah.
rate cuts. So I'm really curious, guys. Are you oakish on or dovish? Let's see what you think. Of course, the consensus is quite high for a rate cut. So,
Yeah, so we can
um,
expect a lot of manipulation today, yeah, Rafa?
oh yeah. Some insider trading. Let's
Yeah.
see the charts how they react. So let's take a look at the charts.
Yeah.
Bitcoin here. We have the 15 minutes chart on Altrady with the order book open and our fantastic smart money indicator. So
Yes.
we have compressed volatility, and of course the market is fully in Fed waiting mode. Dimitro.
Yes, and what I can see these like low volumes, and this is pretty classic pre-announcement behavior. So yeah, we do not see big candles here right now, so only small candles, sideways movement, because yeah, everyone is ready to strike. Yeah.
Oh yeah, and if the rate cut comes in, the price could break above this 95K level
Exactly.
immediately and push toward the upper zone. What do you think, Dimitro?
Yeah, on the contrary, if the Fed surprises or Powell comes out very hawkish, yeah, we need to watch out below. There is actually a liquidity void down here that could accelerate the move. Good.
Yeah, you're right.
Yeah, I
So,
see comment from Soda. So I was using the wrong format again. Oh yeah, it happens. It happens sometimes.
Yeah, so that if you are watching from mobile phone, I mean the chart is quite stretched, so maybe it's better on laptop. This is how people stay rich. Yeah, yeah. All right, guys. So we are getting close. Just a few moments left. 4 minutes to the rate cut announcement. The
Yeah,
intro.
yeah, everyone is ready. So in the last meetings, we've seen 2-3% moves, yeah, in just seconds. Am
Oh
I?
yeah. Oh yeah.
Yeah, yeah, yeah. So yeah, keep your eyes wide open, please.
Yeah. 40 minutes, and we can watch together a sudden spike in any
Yes.
direction. And
What do you
yeah.
think? Long or short, Rafa?
Yeah, I will expect some like sudden move like this immediately, and then going back, dropping again a little bit, and then 30 minutes later, Powell will shows and talk, and let's see. So I have been saying it for days. The right decision is important, but Powell's speech is the real star for today.
Yeah, I agree. Powell holds the direction of the market in his hands. Can you just imagine, yeah? What does he feel? I mean, he knows that, oh my God, I can just move the market in my way, you know. I mean, I want long, I want short, and I just decide to put some news, you know. That's very interesting actually, that one person can have this big influence. Yeah, so if he is too hawkish, he could crush sentiment. If he's too dovish, he could reignite inflationary pressure. So yeah, that's really interesting.
Yeah, yeah, dark on my life. Yeah, I mean, rich people, they can use leverage and more debt. So of course, the system is based on this kind of structure. So it's normal. We
Yeah.
are just retail traders, but we have our method, and actually sometimes we are even more equipped and in favor to some um, spike moves, because if you have a lot of money, like big account whales, it's quite hard to um, enter the market immediately. So it takes more time. That's why
So,
where you're mentioning like rich people, they multiply by investment. That's right, but they take longer time, because they cannot just place an order like us in few click and they get assigned. They need a lot of time, and of course they have to publish their operation by the SEC. So it's different trading world. Yeah, any case, 1 minute left, guys. So let's see. Let me show you the Forex Factory Funk. Federal fund rates, 30 seconds left, and we can see a spike in few
yes,
seconds.
that's going to be interesting one.
Yeah, yeah. 40 seconds. So the forecast, of course, is 3.75%. Maybe it could be lower. I don't think so. But let's see, guys. Let's see. Let's see. Pending.
Okay, we need some drum.
I don't have the drum sound. Okay, guys. Of course, as everyone expected, 3.70%. So another 25 base point rate cuts. Let's see Bitcoin what it's doing.
Some long movement.
Yeah, but actually is not that greeting.
So that it feels like New Year countdown. Yeah, exactly.
No, it's even more important than New Year. Who
Yes.
give a fuck to the New Year? So that is, we are traders.
Yeah. Hello, Leon. Greetings.
Yeah. So no, big reaction so far.
Yeah.
Let's try to move on the
Yeah.
5 minutes.
Market starts move a bit more in volatility mode. Yeah, but not that much.
Yeah, actually, there is a huge spike on volume here, guys. You see the green bar, but the price is pushing back and drawing this shadow. Order book is showing not really relevant orders. But yeah. So I think so far the market already expect these rate cuts. So
Yeah.
let's wait for Fed. So for Powell.
Yeah. I think when Powell will join this, yeah, I think it could be even bigger market moves. I think because yeah, he is very he's very power man.
Yeah, I'm checking the dollar index is dropping a bit, but not that warning. So yeah, guys, stay with us. We will analyze the market reaction later. Now we can watch together some Bloomberg Live, and let's wait for Powell.
Yes.
The first operation will be announced tomorrow with the first purchases on Friday of approximately $40 billion in Treasury bills. Guys?
Michael McKee, stay close as we parse through this. Right now, what you see in markets is a collective cheer. Perhaps this was supposed to be a hawkish cut. The market is taking it slightly differently. S&P had been lower. Now it is positive by almost 0.2%. Euro climbing, dollar falling on the heels of what does seem to be like more Fed cuts. And across the board, 2s, 10s, and 30s, you are seeing a bid into bonds with this feeling that this is a Fed that not only is going to support rates with further rate cuts, but also with additional bond purchases. Tom.
To me, the most interesting nuance here is the dissent of the gentleman from Chicago. This is brilliant academics out of Milton, Yale, and the Massachusetts Institute of Technology. Austin Goolsbee is basically our technology president. He's wired into the internet, wired into the computers. And I'd love to know if his dissent has to do with the vibrancy of AI, which leads to a better productivity, a better GDP. Let's be careful what we do.
Yeah, right now we're looking at nine votes for and 3 dissents. Bob Michael of JP Morgan with us here. What's your first reaction of this decision?
Not as bad as it could have been. There could have been a lot more dissents in favor of no rate cuts. When we look at things like PCE, we expected they would lower core PCE by 1/10. They did that. They left the unemployment rate for next year roughly where it was last year. They did raise their expectation of GDP a couple tenths from where it was. So to me, that seems to be, if you want to call it a hawkish tilt, the one hawkish tilt. And of course, adding the extent and timing of additional adjustments to rate policy going forward, that was pretty much in the market. So I think mostly as the market expected and nowhere near as bad as the market feared.
So not maybe as hawkish of a cut as people thought it might have been. Joining us now is Jim Bianco of Bianco Research. Jim, what's your first reaction to this decision, which, as Bob was saying, isn't as bad as it could have been? It could have been 4 dissents or 5 dissents, only 3 dissents. Is this a victory for Jerome Powell?
It's a victory for Jerome, but I'll take the other side, Bob. I'll say that it's not as good as it could have been. I was hoping for a 7-5 vote. I was hoping for a Fed that was more divided, that was more independent, that was going to send a message to the administration. You could put a guy in that wants to go to 1%, but he's not going to bully us to cut rates next year just because he's the Fed chairman. They kind of left the door open. I think that the Fed can be bullied by the next Fed chairman to do the bidding of President Trump.
Bob, you were saying that you wanted to respond?
Not as good as it could have been with more dissents. I think if you're the administration and you're invested in this market, this is pretty much as good as it could have been, other than no dissents. I'm not sure how additional dissents make this better.
Will McKee dissent at the press conference?
Well, let's find out. Mike, you were parsing through this. You've got something to add. What do you see?
Yeah, well, the point I'd like to make is that the SEP shows that growth is going to pick up significantly next year. Unemployment is going to go down, and inflation is going to go down significantly next year. So what was the rush to cut rates today if they think that's the track that we're on? I think that's going to be a key question for Jay Powell in the news conference. Does this raise the possibility that they could be going the wrong direction with rates? There were some people who made that case before we went into today's meeting, and they're going to be still raising questions about it going forward.
Michael McKee, thank you so much. We will be catching up with you and, of course, listening to your questions. Jim, this is something that is near and dear to your heart as you call yourself a self-dubbed inflationista. Do you think that this really adds to that inflationary pressure if the Fed essentially is accepting that they're not going to get down to their inflation target for 6, 7, potentially even 8 years?
I agree. I think that the Fed has to be very worried about that. We're worried about affordability right now. This price CPI is up 27% since the end of COVID, and that's what people are upset about. How do we fix that? We need the inflation rate to run below 2% for a while so that wages can catch up. If the inflation rate is going to stay at 3 and moderate to 2.5, that is going to keep the affordability anger white hot over the next year to year and a half or so. And so I don't think that accommodating that by cutting interest rates is going to help. And that's the question I hope the chairman gets is, how are you helping affordability with 175 basis points of cuts in the last 14 months?
Jim, we got to review the past here. You were a leader on saying that inflation would be sticky. It was a lonely call years and years ago. And Bianco of Chicago said, you know what, folks, we're not falling down to 2%. So here we are, Jim Bianco. I just want to know the efficacy, Jim Bianco, where he says in the press conference, basically, one and done. We made a rate cut. Maybe we will have a sequence of future rate cuts, but we really now have to wait and see what the data says. Isn't that where we are, Jim Bianco?
Well, that's if that's what he says. And again, what I was trying to say before is if the chairman indicates that it's one and done, means the chairman's running the show. And in May, we're going to have a hand-picked successor from Donald Trump running the show, and we know what Trump thinks about interest rates, and that person's going to want to have lower rates. But if he does say that, then maybe the market will take it a little bit differently, and we'll see if he does. But most of the times he'll just say he's going to be data dependent, and it depends on what the data is.
This is an important vignette, folks, that I think is just so valuable. I'm in a room with Axel Weber, Shirakawa of Japan, the wonderful John Lipsky with all of his work on New York Wall Street, many other worries. Tom Honig was there from Kansas City. And the room fell silent, Bob Michael, when they talked about the next regime of the Fed and the risk here that it would be cut. Is that a legitimate fear that the next chairman and the apparatus will allow us to go towards some regime of new low rates?
Well, I think you have to look at which Fed presidents are coming onto the FOMC next year, and they're mostly in the hawkish camp. So whoever you put in as the Fed chair has to be very persuasive. And I guarantee you the president isn't looking to appoint the next Paul Volcker. They're looking to appoint someone who believes in supply-side economics.
And Lisa, this is critical. This is absolutely critical that we have an analog here with the Bank of England that over time has told the governor of the Bank of England and their chairman equivalent, no, we're not in agreement. We're not going to do it. Is that what our 2027 looks like? Part
of the problem is people get overwhelmed by the state of events. And this is something that you talk about a lot. And Jim, I'd love your thoughts on that. This idea that this is a Fed that is now buying bonds once more, buying notes once more. And they're doing so because of reserves issues and really technical considerations for the market. They don't want another repo freak out. At this point, though, it does indicate a structural issue with how much debt is out there, the government deficit that's not going down, and a question of the Fed's role. Are they being forced to monetize the debt in a way that will keep them artificially easy if you were just going off the economic outlook?
I think they are at least being forced to acknowledge fiscal dominance, that the fiscal situation is important. Basically, The funding market, the repo market, which funds the $38 trillion treasury market, is too small. It's too small because the Fed has been doing QT and reducing reserves. Those interest rates, repo rates, have been going up. Now, one answer could be to tell Congress, you can't spend as much money. You can't run as big a deficit because the funding markets can't handle that size of a market. But if the Fed wants to elect to, let's expand the funding markets to meet the size of the bond market, you're telling Congress, go ahead, spend more money, run bigger deficits. We got your back. We'll continue to expand that funding market to meet those goals. And the biggest driver of inflation over the last couple of years, other than the supply shock that we had in 21, has been government spending. And they seem to be encouraging more government spending.
Bob, do you agree with that?
Absolutely, 100%. But it doesn't change the fact that that's what's occurring and the market's responding to that. I look at everything that just happened in the last few minutes and, everyone got what they wanted. Those hawks on the Fed that didn't want to see a rate cut, they got that. When you look at the Fed futures market, we had 2 rate cuts priced for next year, mid-year and the end of the year. Now there's only 1 price for next year, and it's in the 4th quarter. So you got what you wanted. You got the market moving away from being in a rate cutting regime going forward. But if you look at the doves on the Fed, if you think about the administration, they got what they wanted. They got another 25 basis point taken off of base rates, and the market's responding positively to that. It's rare that everyone gets what they wanted out of an FOMC meeting.
Jim, I love your comments on that, this idea that everyone wins. If you do have monetization of the debt, yes. You do have ongoing fiscal spending, yes. But that helps support the markets, and we're not seeing runaway inflation. So what's the problem?
We're going to get a new Fed chairman. That's the big issue. And the new Fed chairman is going to be perceived to be having a political agenda. And you were hoping that the current members of the FOMC were going to act as an independent break on a political agenda that was coming in. And that's why I wanted to see more dissents to signal that they were ready, willing, and able to be that political break. Now, maybe they will once we get that new Fed chairman, but then that looks political that they didn't take the chance to do it before the new guy came.
Tim Bianco, thank you so much, as always, for your insights. This really is going to be the debate. How does Fed Chair Jay Powell position himself and position the FOMC as being politically independent at a time that's highly politically charged? We hear every single day about the Fed Chair from this president.
The redo of independence is the core issue, particularly in the heritage of the Fed back to 1951, and it's under threat, no question about that. It'll be interesting to see if the president gives way. As Bob Michael mentioned, the FT article today talking about, well, maybe it isn't 100% or 90% Dr. Hassett, and you get to a point where there's a renewed debate. We'll have to see on that. To me, it's a Chicago Fed meeting. We had Goolsbee dissenting, which is a shock in itself, and to have Jim Bianco with us is wonderful. Diane Swank owns the high ground of Middle America with KPMG. She's not out of 3 zip codes in Manhattan and joins us this afternoon. I look, Diane, at this moment, and when I see Goolsbee's dissent, and it's essentially a Chicago dissent. It's a dissent of productivity. Do we have any idea with this new AI that we have a new productivity that will allow for a better real GDP, a more effective and efficient America?
We don't know that yet. What we do know is that productivity growth has moved up, and that's because firms are doing more with less. We don't know that it's all from AI. We haven't seen enough adoption of AI yet to get there. And also what we don't know is how AI will be used, whether or not we'll see a lot of new jobs from this new innovation. That's usually what we see from innovation. Certainly that's not what Silicon Valley is telling us at this point in time. And also it matters who the gains of the AI actually accrue to. If those productivity gains continue to accrue to the owners of capital instead of workers are going to feel left behind. And they're already feeling left behind because of the fact that the level of prices, as Jim pointed out, is just too high. Even if inflation were to cool from here, the level of prices are still too high.
Lisa, I set up that question because I knew what Dr. Swank would say. Who's going to be the winner of productivity? Who are going to be the winners out there? And that's the ultimate political tension.
Which is the reason why the Fed's role in this is getting increasingly politicized. Dan, I'd love your take on how this Fed is taking into account productivity gains of AI and talking about Goldilocks, because essentially that is the scenario that they laid out in their statement of economic projections.
Well, the Goldilocks scenario really requires, with productivity growth, it to be broad-based. And actually, people always forget this part of it. If productivity growth, they raise their growth rates for next year. If productivity growth is driving gains in overall economic growth, it means we can actually have higher break-evens on the Fed funds rate because the economy can grow more rapidly without having to lower rates. And I think that's important as well. And so we've really not seen all this yet, and I think it's still ahead of us. I am worried about the fact that we're getting fiscal stimulus in the form of the largest tax refund surge on record in the first and second quarter. Will hit between March and May. And we know that those tax refunds are treated like windfall gains due to the expansions of tax cuts passed in July of last year. They're retroactive to beginning of 2025. And that's going to be a big bump in fiscal stimulus at a time when we're still feeling the inflation from both tariffs and changes in immigration policy.
Yeah.
And I think that's really important. We're seeing service sector inflation pick up as well.
If that's the case, Diane, why are not forward break-even rates rising substantially? I was looking just now at the 5-year, 4-year forward break-even rates, and they actually went down after this Fed decision, not up, even though exactly what you're saying. If you do believe that there will be some additional fiscal stimulus that would be inflationary, you would think that this rate decision would only encourage those inflation fears.
I think we've seen some of it in financial markets already. The fact that it's not happening today doesn't mean it won't happen. And we've already seen some nervousness in the bond market, skittishness about the size of debt that they have to absorb, the mega merger deals that are coming out that are also financed by debt. All of that together, along with the fact that we're now going to see in 2026, the government debt is going to eclipse the size of the economy. It has not done that since World War II. And so we're moving into new territory. And I think a lot of things, people are sort of looking at the way the world was rather than what's changing, and things are changing very rapidly.
If you are just joining us, we did get that Fed rate decision. They did lower by 25 basis points as widely as expected. 9-3 vote, 3 dissents. The news really is that Austin Goolsbee joined the Fed's Schmidt in dissenting, saying that they should not lower rates. You, of course, had Stephen Myron, Fed governor, talking about a 50 basis point cut, dissenting on the other side. Not as many dissents as people had expected. The Fed did revert back to what we saw in the October statement, using language used just before pausing rate cuts. So potentially the last Fed rate cut for a long time by this chair, Jay Powell. I'm just wondering, Bob, if you think that right now this market is saying they are okay to do this, that the data that is available really doesn't signal that this cut and then maybe one more next year really is going to be inflationary.
Well, I think that's what the market's hoping for. I think there are a lot of businesses that we invest in where we do see the productivity gains from AI already. We also know within our own bank there are significant productivity gains. So some of that is already out there. The unfortunate price reset from pre-COVID levels to today is also a problem. I get that. But that's dampened aggregate final demand. What do we want going forward? Do we want the disinflation we seem to be in and what the Fed is projecting? Or do we want deflation where prices come down? I would argue we still want disinflation, and hopefully there will be a point in time in the not too distant future where wage growth and the trend in disinflation will normalize prices again. But all of that still is a headwind to consumption. So businesses are very careful how much cost increases they push through now.
Can I do a counterfactual?
Please.
Diane Swank, if we got a 50 beep Myron cut, what would happen to the American economy now? With the financialization of the American system, if you gave us a 50 beep cut now, it'd be a veritable banking explosion, wouldn't it?
It would certainly add a lot more stimulus to what we're already seeing, and stimulus is heat. Heat is inflation, unless you can really get all those offsets from AI in the right places. And I think that's the hard part, is the old economy is where the tariffs are hitting the hardest in manufacturing activity. And we are seeing it come through in prices. And we're also seeing labor shortages, even as the labor market weakens, in pockets where immigrants have dominated. That's showing up in prices as well. In-home elder care, childcare costs, all soaring. That was just in September. And those shortages have only gotten worse since then.
Lisa, 2020, I looked at the clock right when Diane Swank said tariffs. First time we got to tariffs was 20 minutes into the show. For most of our audience, tariffs are a big deal. They're affecting their groceries, their healthcare, everything in the service sector as well.
Yeah, plastic Christmas trees 15 to 20% higher because of tariffs. There you go. So this also is
a real Christmas tree or fake?
Fake Christmas tree, but it's also increasing the real ones because there are other people. Diane Swank, we'll let you stay out of this conversation. Thank you so much for being with us, joining us now for this conversation, not this conversation. Matt Lazzetti of Deutsche Bank with us, as you typically do before the Fed press conference. Matt, just first, what's your impression? 9-3, was this what you thought would happen?
Yeah, to be honest, I think in terms of the statement, the SEP, the dissents, I think it was very much in line with expectations. Certainly there was scope to get greater dissents from a hawkish direction than what we got. I think 4 regional Fed presidents, potentially Governor Barr, was also leaning against this cut. But we always thought that it was the job of Chair Powell, through the statement, the language change that we got there, but then I think coming up to the press conference signals that he sends, to try to rein in some of those dissents, to have a hawkish message that allows those officials to speak through that. And so I think we probably got that as well. You're seeing markets respond by taking rates down. I don't think that's really anything that we saw in the statement or the SEP or the dissents. I think it really was the Fed ramping up reserve management purchases, these T-bill purchases, a little bit earlier than was expected.
Matt Lazzetti, Vinky Chadha is high on the street looking at the equity markets. He says the stock market's going to go up, up, up. How do you attach Lazzetti economics to Bikram Chadha's huge equity outlook?
Yeah, I think the good thing about how we do it here is internally consistent. So I think Binky takes our economic growth forecasts, our global economic growth forecast, and builds that into his earning projections. We have 2.4% growth for the U.S. economy over the next year. That was sounding, I think, quite bullish relative to consensus expectations. But I would note the Fed median forecast came up to 2.3% today. I think was revised higher than what many anticipated, and is now much closer to our own expectations. So I think these two things are mutually reinforcing. We see a stronger growth backdrop. We see financial conditions easing through Binky's equity channel, and those two things reinforcing each other over the next year.
Matt, your other colleague, Jim Reed, put out a provocative question earlier this morning saying, what if the next Fed move was up? At what point do you think that the move that the Fed is laying out really sets up that counterfactual in a more real way?
Yeah, certainly a provocative question. And I think over the next year, we are getting more questions about that. And I think it's more coming from the global sphere at this point. You're seeing places like the RBA turn a little bit more hawkish. There's questions about the ECB. Bank of Canada, they're seeing stronger economic data as of late. For the Fed specifically, though, I think you need 2 things to happen. One, you have to have a clear elimination of downside risks to the labor market. We are not there yet. There's still some fragility in this labor market over the next several months. Perhaps by the end of next year, we could get there. And 2, you need the labor market to return as a source of inflationary pressure. So you need the unemployment rate to decline, quits rate to move higher, and wage growth to accelerate. I think it's possible. I think you are seeing a substantial reduction in labor supply in the U.S. economy. I think if you were to add on even more fiscal stimulus, so if we were to get these $2,000 stimulus checks from the Trump administration, I think that's the type of dynamic where that could really shift the debate. People would begin to think a little bit more actively about rate cuts in the U.S. But to be clear, I don't think we are there. Our baseline expectation is the next move is a cut.
Bob, what do you think? What do you think it would take for the Fed's next move or a move next year to be a rate hike and not a cut?
Well, I think you'd have to see the fiscal stimulus from the One Big Beautiful Bill Act hit and accelerate business investment and consumer spending. You'd have to see a labor shortage resulting from that, and you'd have to see a wage price spiral. maybe you'll see that in the second quarter, but right now the Fed threaded the needle. Can't we just enjoy this into the holiday season?
You know us.
That's the smartest thing I've heard today. That's the smartest thing I've heard. And Powell's a pinata, I get that. But the bottom line is we have a prosperous economy for the haves. Let's not upset that apple cart while everyone, well-meaning, tries to help people that are struggling so much. I mean, that's threading the needle right now is what we're doing.
Well, yes, but let's not forget that the One Big Beautiful Bill Act also has no taxes on tips, overtime, Social Security payments.
Right.
A lot of those are concentrated in the bottom couple quintiles of earners. So there should be some relief coming there.
Where's your lack of conviction? Matt Lazzetti on an Outlook and off of this Fed meeting today. Where's the question of your conviction into next year? What are you most worried about?
Yeah, I think in the very near term is that the labor market dynamic, which is this fragile equilibrium with low hiring and low firing, breaks to the downside. That you begin to see layoffs pick up. I really don't think we see that evidence as of yet, but it's a real risk over the next several months.
Do you agree?
I think over the course of 2026, I think there's some risks to the upside here. As Bob mentioned, on the fiscal side, the stimulus checks that have been floated, not part of our baseline, but would be a very real upside risk. And then I think we just can't put aside these risks around Fed independence. And, we heard Treasury Secretary Bessent talking about regional Fed president, and we have to go through those votes. And you have a Supreme Court case for Lisa Cook coming up early next year. So I think that there are a lot of risks associated with it. From a Fed independence perspective, inflation risk potentially to come, long end of the bond market also at risk potentially from that.
Matt, we have about 3.5 minutes before the press conference begins. From your perspective, what's the one question you have for Fed Chair Jay Powell, potentially at the last Fed cut that he oversees?
Yeah, I think it's a little bit around the language that they introduced into the labor market and into the statement. How are we to think about that? Is that clearly sending a signal that there's a much higher bar in the near term? I also would ask him, are you internalizing what could be a very weak jobs report next week in today's decision? I think that's a really important thing for the market. I think the Fed would probably want to take out some of the sensitivity to next week's data. I think one of the reasons that Chair Powell wanted to push this rate cut through was an expectation you could see some weakness there. My expectation is, next week's data is going to be volatile. They are really putting more weight on the December jobs report in early January and the data we're going to get early next year in that assessment. But I'd like to get confirmation of that from the chair today.
Matt Lazzetti, thank you as always for your time, and I look forward to hearing what you think after the Fed conference. This is an important point. How much is this, in some ways, forecasting that December 16th jobs report that we should have already had? It should have been sort of 1-2 punch where last Friday we got the November jobs report. They took that data into hand, and then this meeting, they responded to it. Bob?
Yeah, I think you can go back to September and say this is another risk management adjustment to policy, that there are some signs of a soft labor market. You're far away from what you're forecasting as your neutral rate. Why not take another 25 basis points off of that? It will help corporate America. I'll get a lot of questions in the next few days. Does 25 basis points actually do anything? Let's remember, most of corporate America are small and middle market businesses. Think of a $50 million EBITDA company. They generally have 7 times leverage. They've got $350 million worth of debt on top of $50 million in EBITDA. It helps them a lot. It helps stabilize middle market corporate America significantly.
If we say it's an original meeting, we've got to stagger to the next meeting, and we'll be wiser. We'll have data and all that. But as Lisa mentioned at the top of the show, the political overlay here is extraordinary. What did J.P. Morgan's Washington experts say about the politics of January?
Well, the question I would want to ask Powell is, were there only 3 dissents, or was there a considerable amount of bargaining to go from 5 dissents to 3 dissents? And was that in the statement? And then you ratcheted it up, GDP, 0.5% from where?
All right, guys, Powell to speak any moment, so be ready.
directly influence the current Federal Reserve Board is?
That was a fantastic question, and I hope that he gets asked that as we really look to understand just what kind of clutch the Fed chair holds over this committee. Bob Michael, as always, thank you so much for being with us for all this time. Truly, always one of the absolute best. Right now in markets, a collective sigh of relief. It could have been a lot worse. That is sort of the message coming from it. The S&P up 0.1%. NASDAQ still suffering a little bit, down 0.2% suffering, I say. Still near all-time highs. And the Russell 2000 seeing that pop up 0.6%. What you are seeing in the bond space, 2s, 10s, and 30s, is this lift to bond price down in yield as people expect to see some sort of bond purchases as well as a rate cut coming in next year. It really seems to me that Jay Powell really has the chance to split the difference.
We'll have to see. I'm going to watch the bond vigilantes. I think they're in the press conference as well. Giordani's in there somewhere.
Well, let's take a
Here we go, guys. Here comes Powell. Let's listen carefully to his words and see what the real monetary, liquidity, and economic situation of the United States is.
We're really focused on achieving our dual
Yeah, let's see.
maximum employment and stable prices for the benefit of the American people. Although important federal government data for the past couple of months have yet to be released, available public and private sector data suggests that the outlook for employment and inflation has not changed as much since our meeting in October. Conditions in the labor market appear to be gradually cooling, and inflation remains somewhat elevated. In support of our goals, in light of the balance of risks to employment and inflation, today, the Federal Open Market Committee decided to lower our policy interest rate by 0.25 percentage point. As a separate matter, we also decided to initiate purchases of shorter-term Treasury securities solely for the purpose of maintaining an ample supply of reserves over time, thus supporting effective control of our policy rate. I will have more to say about monetary policy and its implementation after briefly reviewing economic developments. Although some key government data have yet to be released, available indicators suggest that economic activity has been expanding at a moderate pace. Consumer spending appears to have remained solid, and business fixed investment has continued to expand. In contrast, activity in the housing sector remains weak. The temporary shutdown of the federal government has likely weighed on economic activity in the current quarter, but these effects should be mostly offset by higher growth next quarter, reflecting the reopening. In our summary of economic projections, the median participant projects that real GDP will rise 1.7% this year and 2.3% next year, somewhat stronger than projected in September. In the labor market, although official employment data for October and November are delayed, available evidence suggests that both layoffs and hiring remain low, and that both households' perceptions of job availability and firms' perceptions of hiring difficulty continue to decline. The official report on the labor market for September, the most recent release, showed that the unemployment rate continued to edge up, reaching 4.4%, and that job gains had slowed significantly since earlier in the year. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen in recent months. In our SEP, the median projection of the unemployment rate is 4.5% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Very little data on inflation have been released since our meeting in October. Total PCE prices rose 2.8% over the 12 months ending in September, and excluding the volatile food and energy categories, core PCE prices also rose 2.8%. These readings are higher than earlier in the year as inflation for goods has picked up, reflecting the effects of tariffs. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have declined from their peaks earlier in the year, as reflected in both market and survey-based measures. Most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 2.9% this year and 2.4% next year, a bit lower than the median projection in September. Thereafter, the median falls to 2%. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a quarter percentage point to 3.5 to 3.75%. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. There is no risk-free path for policy as we navigate this tension between our employment and inflation goals. A reasonable base case is that the effects of tariffs on inflation will be relatively short-lived, effectively a one-time shift in the price level. Our obligation is to make sure that a one-time increase in the price level does not become an ongoing inflation problem. But with downside risks to employment having risen in recent months, the balance of risks has shifted. Our framework calls for us to take a balanced approach in promoting both sides of our dual mandate. Accordingly, we judged it appropriate at this meeting to lower our policy rate by a quarter percentage point. With today's decision, we have lowered our policy rate 0.75 percentage point over our last 3 meetings. This further normalization of our policy stance should help stabilize the labor market while allowing inflation to resume its downward trend toward 2% once the effects of tariffs have passed through. The adjustments to our policy stance since September bring it within a range of plausible estimates of neutral and leave us well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks. In our summary of economic projections, FOMC participants wrote down their individual assessments of an appropriate path of the federal funds rate under what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.4% at the end of 2026 and 3.1% at the end of 2027, unchanged from September. As is always the case, these individual forecasts are subject to uncertainty and they're not a committee plan or decision. Monetary policy is not on a preset course, and we will make our decisions on a meeting-by-meeting basis. Let me turn now to issues related to the implementation of monetary policy, with the reminder that these issues are separate from and have no implications for the stance of monetary policy. In light of the continued tightening in money market interest rates relative to our administered rates and other indicators of reserve market conditions, the committee judged that reserve balances have declined to ample levels. Accordingly, at today's meeting, the committee decided to initiate purchases of shorter-term Treasury securities, mainly Treasury bills, for the sole purpose of maintaining an ample supply of reserves over time. Such increases in our securities holdings ensure that the federal funds rate remains within its target range and are necessary because the growth of the economy leads to rising demand over time for our liabilities, including currency and reserves. As detailed in a statement released today by the Federal Reserve Bank of New York, reserve management purchases will amount to $40 billion in the first month and may remain elevated for a few months to alleviate expected near-term pressures in money markets. Thereafter, we expect the size of reserve management purchases to decline, though the actual pace will depend on market conditions. In our implementation framework, an ample supply of reserves means that the federal funds rate and other short-term interest rates are primarily controlled by the setting of our administered rates, rather than day-to-day discretionary interventions in money markets. In this regime, standing repurchase agreement or repo operations are a critical tool to ensure that the federal funds rate remains within its target range, even on days of elevated pressures in money markets. Consistent with this view, the committee eliminated the aggregate limit on standing repo operations. These operations are intended to support monetary policy implementation and smooth market functioning and should be used when economically sensible. To conclude, the Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing our inflation sustainably down to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. At the Fed, we will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Okay, everyone. So Powell said pretty much the same thing as last time, highlighting that inflation is still high, that the labor market is holding up, but unemployment is rising, even if data is delayed with the shutdown. The Fed has finished quantitative tightening and started quantitative easing, so money printing has started again. And only 2 rate cuts are expected for next year, but I really don't think there is a possible scenario. Now let's listen for the question from the participants.
Based on the incoming data, the evolving outlook, and the balance of risks. That new language points out that we'll carefully evaluate that incoming data. And also, I would note that having reduced our policy rate by 75 basis points since September and 175 basis points since last September, the Fed funds rate is now within a broad range of estimates of its neutral value, and we are well positioned to wait to see how the economy evolves.
And if I could follow up on the outlook there, it seems like with the additional GDP growth coupled with easing inflation and a fairly steady unemployment rate, this seems like a pretty optimistic outlook for next year. What's given rise to that? Is this an early bet on AI? Is there some sense of improving productivity out there? What's driving that?
So a number of things are driving what's happening in the forecast. And I would say if you look broadly at outside forecasts, you do see a pickup in growth in many of those now too. So it is it's partly that consumer spending has held up. It's been resilient, and it to another degree it is that AI spending on data centers and related to AI has been holding up business investment. So overall, the baseline expectation for next year is, at least at the Fed, and I think with outside forecasters too, is a pickup in growth from today's relatively low level of 1.7%. I mentioned that the SEP median is 1.7 for this year growth and 2.3 for next year. You actually, some of that is due to the shutdown. So you can take 0.2 out of 2026 and put it in 2025. So it would really be 1.9 and 2.1. But overall, yes, for a few reasons, fiscal policy is going to be supportive. And as I mentioned, AI spending will continue. The consumer continues to spend. So it looks like the baseline would be solid growth next year.
Steve.
Thank you, Mr. Chairman, for taking our questions here. You had previously described rate cuts in terms of a risk management framework, and kind of following up on what Howard was asking, is the risk management phase of rate cuts over here? And have you taken out sufficient insurance, I guess, against potential weakness in terms of the data we might get next week when it comes to employment?
So we're going to get a great deal of data between now and the January meeting, and I'm sure we'll talk more about that. And the data that we get are going to factor into our thinking. But yes, we have. If you go back, we held our policy rate at 5.4% for more than a year because inflation was high, very high, and unemployment in the labor market was really solid at that point. So what happened is over last summer of 24, inflation came down and the labor market began to show real signs of weakness. And so we decided, as our framework tells us to do, that when the risks to the two goals become more equal, you should move from a stance that favors really dealing with one of them, in that case inflation, to a more balanced, more neutral setting. And so we did that. We did some cutting, and then we paused for a while to work our way through what was happening in the middle of the year. And then we resumed cuts in September. We've cut now 3. We've now cut a total of 175 basis points. And as I mentioned, we feel like where we're positioned now we're well positioned to wait and see how the economy evolves from here.
If I could just follow up on the SEP, you have a whole lot of a big increase in the growth numbers, but not a big decline in the unemployment numbers. And is that an AI factor in there? What is going on through the dynamic of you get more growth, but you don't get a whole lot of decline in unemployment? Thank you, sir.
So it is, the implication is obviously higher productivity. And some of that may be AI. It just also, I think, productivity has just been almost structurally higher for several years now. So if you start thinking of it as 2% per year, you can sustain higher growth without more job creation. Of course, higher productivity is also what enables incomes to rise over long periods of time. So it's basically a good thing. But that's certainly the implication.
Thank you. Colby Smith with the New York Times. Today's decision was clearly very divided. It wasn't just the 2 official dissents against a cut, but there were also soft dissents from 4 others. And I'm just wondering if this reluctance from several people to support recent reductions suggests that there is a much higher bar for cuts in the near term. And what exactly does the committee need to see if things are well positioned right now to support a January reduction?
Sure. So let me just say, as I mentioned here before, the situation is that our 2 goals are a bit in tension, right? So interestingly, everyone around the table at the FOMC agrees that inflation is too high and that we want it to come down, and agrees that the labor market has softened and that there's further risk. Everyone agrees on that. Where the difference is how do you weight those risks, and what does your forecast look like, and where do you ultimately where do you think the bigger risk is, and it's very unusual to have persistent tension between the 2 parts of the mandate, and when you do, this is what you see, and I think it's actually what you would expect to see, and we do see it. Meanwhile, the discussions we have are as good as any we've had in my 14 years at the Fed. They're very thoughtful, respectful, and you just have people who have strong views, and we come together and we reach a place where we can make a decision. We made a decision today. We had 9 out of 12 supported it, so fairly broad support. But it's not like the normal situation where everyone agrees on the direction and what to do. It's more spread out, and I think that's only inherent in the situation. In terms of what it would take, we all have an outlook in terms of what's going to come, but I think ultimately having cut 75 and the effects of the 75 basis points will only begin to be coming in. As I've said before a couple of times, we're well positioned to wait to see how the economy evolves. We'll just have to see, and we will get, as you know, quite a bit of data. I should mention on the data, as long as I'm talking about it, that we're going to need to be careful in assessing, particularly the household survey data. There are very technical reasons about the way data are collected in some of these measures, both in inflation and in labor, in the labor market, so that the data may be distorted and not just sort of more volatile, but distorted, and that's really because data was not collected in October and half of November. So we're going to get data, but we're going to have to look at it carefully and with a somewhat skeptical eye by the time of the January meeting. Notwithstanding that, we will have a lot of the December data by the time of the January meeting. So we expect to see a lot more, but I'm just saying that the what we get for example, CPI or for the household survey, we're gonna look at that really carefully and understand that it may be distorted by very technical factors.
And just one more question on dissents. You talk about it in a very positive way, just given the complicated nature of the situation we're in economically. But is there any point in which those dissents become counterproductive, either to the Fed's communication and the messaging around the policy path forward?
I don't feel that we're at that point at all. I don't. I would say, again, these are good, thoughtful, respectful discussions, and you hear people say, and you hear many outside analysts say the same thing. I could make a case for either side. I could make that case. It's a close call. We have to make decisions, and we always hope that the data will give us a clear read. But in this situation, you have competing. If you look through the SEP, you'll see that a very large number of participants agree that risks are to the upside for unemployment and to the upside for inflation. So what do? You've got one tool. You can't do two things at once. So at what pace do you move? What size moves do you make, and that kind of thing? And what's the timing of them? It's a very challenging situation. I think we're in a good place to, as I mentioned, to wait and see how the economy evolves.
Nick.
Nick Timmeros of the Wall Street Journal. Chair Powell, there's been some discussion recently in the 1990s. In the 1990s, the committee did two discrete sequences of 3 quarter-point cuts, one in 1995-96 and one in 1998. And after both of those, the next move in rates was up, not down. With policy now closer to neutral, is it a foregone conclusion that the next move in rates is down, or should we think of policy risks as genuinely two-sided from here?
So I don't think that a rate hike is anybody's base case at this point, and I'm not hearing that. What you see is some people feel we should stop here and that we're at the right place and just wait. Some people feel like we should cut once or more this year and next year. But when people are writing down their estimates of policy of where it should go, it is either holding here or cutting a little or cutting more than a little. So I don't see the base case as involving that. So of course, a data set of 2, now 3 is not a big data set, but you are right about those 2 3-cut times in the 90s.
If I could follow up, the unemployment rate has been rising very gradually for the better part of 2 years, and indeed the statement today no longer describes the unemployment rate as remaining low. What gives you confidence it won't continue rising in 2026, especially when housing and other rate-sensitive sectors still appear to be feeling restrictive policy from the, notwithstanding the 150 basis points in cuts prior to today?
So I think the idea is that with now having cut 75 basis points more now and having policy, I call it in a broad range of plausible estimates of neutral, that will be a place which will enable the labor market to stabilize or to only tick up 1 or 2 more tenths. But we won't see, any kind of a sharper downturn, which we haven't seen any evidence of at all. At the same time, policy is still in a place where it's not accommodative, and we feel like we have made progress this year in non-tariff related inflation, and as tariffs come through, as they flow through, that'll show through next year. But as I said, we're well placed to wait and see how that turns out. That is our expectation, but we're going to start to see the data, and it'll tell us whether we were right or not.
Claire Jones, Financial Times. A lot of people interpreted your comments at the October meeting that, when there's a foggy situation, we slow down, to mean that, there wouldn't be a cut now, there'd be a cut in January instead. So it'd be good to get a sense of why did the committee decide to move today rather than to move in January instead? Thank you.
Right. So in October, I said that there was no certainty of moving, and that was indeed correct. I said it's possible you could think about it that way, but I was careful to say other people could look at it differently. So why did we move today? I would say point to a couple things. First of all, gradual cooling in the labor market has continued. Unemployment is now up 0.3 from June through September. Payroll jobs averaging 40,000 per month since April. We think there's an overstatement in these numbers by about 60,000, so that would be negative 20,000 per month. And also, just to point out one other thing, surveys of households and businesses both show declining supply and demand for workers. So I think you can say that the labor market has continued to cool gradually, maybe just a touch more gradually than we thought. In terms of inflation, it's come in a touch lower, and I think the evidence is kind of growing that what's happening here is services inflation coming down, and that's offset by increases in goods. And that goods inflation is entirely in sectors where there are tariffs. So that does build on the story. And so far, it's only a story that this is that the goods inflation, which is really the source of the excess at this point, that almost more than half the source of the excess inflation is goods, is tariffs. And you've got to say then, so what do we expect from tariffs? And I would say that is to some extent down to looking for broader economic, heat. Do we see a hot economy? Do we see constraints? Do we see what's going on with wages? You saw the ECI report today. It doesn't feel like a hot economy that wants to generate, Phillips curve kind of inflation. So we look at all those things, and we say that this was a decision to make. It obviously wasn't unanimous, but overall that was the judgment that we made, and that's the action we took.
Just on the ample reserves point, how concerned were people around the table about some of the tensions we've seen in money markets?
I wouldn't say concerned. So what really happened is this. Balance sheet shrinkage, sometimes called QT, went on. We had a framework in place for monitoring it, and nothing happened. The overnight reverse repo facility went down pretty much close to zero. And then beginning in September, the federal funds rate started to tick up within the range, right? And it ticked up almost all the way to interest on reserve balances. There's nothing wrong with that. What that's telling you is that we're actually in an ample reserves regime. So, we knew this was going to come. When it finally did come, it came a little quicker than expected, but we were absolutely there to take the actions that we said we would take. So, and those actions are today. So, we announced that we're resuming reserve management purchases. That is completely separate from monetary policy. It's just we need to keep an ample supply of reserves out there. Why so big? The answer to that is, if you look ahead, you'll see that April 15th is coming up, and our framework is such that we want to have ample reserves even at times when reserves are at a low level temporarily. So that's what happens on tax day. People pay a lot of money to the government, reserves drop sharply and temporarily. So this seasonal buildup that we'll see in the next few months was going to happen anyway. It was going to happen because April 15th is April 15th. There's also a secular ongoing growth of the balance sheet. We have to keep reserves, call it constant as it relates to the banking system or to the whole economy. And that alone calls for us to increase about $20-25 billion per month. So that's a small part that's going on. It's also happening in the context of a temporary few month front loading to get reserves high enough to get through the tax period in mid-April. So that's what's happening there.
Andrew.
Thanks, Mr. Chairman. This is the last post-FOMC press conference before an important Supreme Court hearing next month. Can you talk about how you're hoping the Supreme Court will rule? And I'm just curious why the Fed's been so reticent on such a pivotal matter.
It's not something I want to address here, Andrew. We're not legal commentators. It's before the courts, and we think we don't think that we help matters by trying to engage as a public discussion of that. I'll give you a mulligan though.
No, thanks. I don't know if that means I get three questions, but
just one more.
I guess I wanted to come back to the 1990s question, and like, do you see that as a useful model for thinking about what is happening in the economy right now?
I don't think it rises to that level. So I did think that in 2019, where we cut 3 times, but this is such a unique situation. It's not the 1970s, let's put it that way, but we do have tension between our two goals. And so that's just unique in my time at the Fed. And I think going back a long ways, we haven't had that in our framework. Our framework, as you know, says that when that's the case, that we try to, take a balanced approach to the two things, that we look at how far they are and how long it would take to get them back to each of them back to the goal. And that's a very subjective analysis, really. But it just tells you got to, and I think ultimately what it says is when they're broadly equally threatened, are equally at risk, you should be kind of neutral. Because if you're either accommodative or tight, you're favoring one or the other goal. And so we've been sort of moving in the direction of neutral. Now we're in the range of neutral. We're in the high end of the range of neutral, I would say. And that's what we're doing now. It so happened that we've cut 3 times. That we haven't made any decision about January, but as I've said, we think we're well positioned to wait and see how the economy performs.
Edward.
Thanks, Mr. Chairman. Edward Lawrence with Fox Business. I wanted to ask you, the inflation expectations has come down in your SEP report. Do you see the tariff price increases as passing through in the next 3 months? Is it a 6-month process that we're looking for that to end? And then because of that, is jobs the threat to the economy?
So with tariff inflation, there's the announcement of a tariff, and then there's, they start to take effect, and then it takes some months. Goods may have to be shipped from other parts of the world. It may take, quite a while for an individual tariff to take its full effect. But once it's had that effect, then the question is, isn't that just a one-time price increase? So we actually look at it, all of the announcements and what you get from all that. You see sort of for each one of them, there's a time period, and then it's fully in. So if there are no new tariff announcements, and we don't know that, but let's assume there are no major new tariff announcements, inflation from goods should peak in the first quarter or so, right, or roughly. We haven't been able to predict this with any precision. No one is. But call it the first quarter or so of next year should be the peak. And from here, it shouldn't be big. It should be a couple tenths or even less than that. We don't really have precision on this. And after that, again, if there are no new tariffs that are being announced, that will take 9 months to get fully in. 9 months is also an estimate. Then you should start to see that coming down in the back half of next year.
And I wanted to see if I could address sort of the elephant there. The president's been talking openly about a new Fed chairman. Does that hinder your current job right now or change your thinking at all?
No.
No mulligans for it. Michael McKee from Bloomberg Radio and Television. 10-year rates are 50 basis points higher than when you started cutting back in September of 2024, and the yield curve basically has been steepening. Why do you think that continuing to cut now, especially in the absence of data, is going to bring down the yield on the thing that will move the economy the most?
So we're looking at the real economy and focusing on that. And you've got to, when the long bonds move around, you've got to look at why they're moving around. If you look at inflation compensation, it's very, that's one part of it is inflation compensation break-evens. And, they're at very comfortable levels. They're at levels consistent once you get out past the very short term now. Break-evens are at quite levels that are quite consistent with 2% inflation over time. So there's nothing happening with rates going up out there that suggests concern about inflation in the long term or anything like that. I mean, I look at these things pretty regularly. Same thing with surveys. Surveys are all saying that the public understands our commitment to 2% and expects us to get back there. So why are rates going up? It has to be something else. It must be, an expectation of higher growth or something like that. And that's a lot of what's been going on. I mean, you saw a big move, toward the end of last year, which was not to do with us. It was to do with other developments.
Well, you just mentioned that the public is expecting you to get back to 2%, and Americans overwhelmingly are citing high prices, inflation as their number one concern. Can you explain to them why you're prioritizing the labor market, which seems relatively stable to most people, instead of their number one concern, inflation?
So we, as you know, we have a network of contacts in the U.S. economy, which is really unmatched if you go through the 12 reserve banks. So we hear loud and clear how people are experiencing really costs. It's really high costs. And a lot of that is not the current rate of inflation. A lot of that is just embedded higher cost due to higher inflation in 2022 and 23. So that's what's going on. And so the best thing we can do is restore inflation to its 2% goal, and our policy is intended to do that, but also have a strong economy where real wages are going up, where people are getting jobs and earning money, and we're going to need to have some years where real compensation is higher, it's positive, significantly positive. So nominal wages are higher than inflation, for people to start feeling good about affordability issue. And, so we're working hard on that. We're trying to keep inflation under control, and also support the labor market and strong wages so that people are earning enough money and feeling economically healthy again.
Victoria.
Hi, Victoria Guida with Politico. Just to follow up on that, I mean, this is now the third time that you've cut this year and inflation is around 3%. So is the message that you're sort of trying to send with that you're okay with where inflation is for now, as long as people understand that at some point you still want to get back to 2% because inflation is relatively stable where it is?
Everyone should understand, and the surveys show that they do, that we're committed to 2% inflation, and we will deliver 2% inflation. But it's a complicated, unusual, difficult situation where the labor market is also under pressure, where job creation may actually be negative. Now, supply of workers has also gone way down, so the unemployment rate hasn't moved that much. But it's a labor market that seems to have significant downside risks. People care a lot about that. That's their jobs. That's their ability, if they get laid off or if they're entering the labor force, to find work. So that's really important to people. The story with inflation, and we're well aware that this is a story at this point, is that if you get away from tariffs, inflation is in the low 2s, right? So it's really tariffs and that's causing most of the inflation overshoot. And we do think of those as likely to, in the current situation, as likely to be a one-time price increase. Our job is to make sure that it is, and we will do that job. But right now, you've got this difficult balance, and there are risks to both sides. There's no risk-free path. If it was just inflation and the labor market was just really strong, and then rates would be higher, as they were for more than a year. We didn't have to worry about inflation. Sorry about the labor market, because the labor market unemployment was very low. If you remember when inflation was very high, there was a labor shortage, so we could focus entirely on inflation. Now it's different. We actually have risks to both. And I think we're doing the best we can for people. They also care about their jobs. They do care about affordability. And the best thing we can do there is both to support economic activity, but also, make sure that when tariff inflation goes down and disappears, inflation lands around 2%.
Elizabeth.
Thanks so much, Elizabeth Schulze with ABC News. Just to follow up, you keep talking about job growth being negative. Why do you think job growth is so much worse than some of the official data? Why do you think job growth is, to follow up on your comments about job growth, why is it so much worse than the official data is suggesting?
Oh, well, we know, I think I don't think this is particularly controversial. It's very difficult to estimate job growth in real time. They don't count everybody. They have a survey. And there's been something of a systematic overcount. And so we expected, and they correct it twice a year. So the last time they corrected it, we thought the correction would be 800,000 or 900,000. I won't get the numbers exactly right. And that was exactly what happened. So we think that has persisted. And so there's an overcount in the payroll job numbers, we think, continuing, and it will be corrected. I don't have the exact month in my head right now, and that's just, I think forecasters generally understand that. So, and we think it's about 60,000 a month, so 40,000 jobs could be negative 20, and that could be wrong by 10 or 20 in either direction. But in any case, but the thing is, that's job creation in a way. That's demand. Labor supply has also come down quite sharply. So, if you had a world where there's just no growth in workers, and you really don't need a lot of jobs to have full employment, some people argue that's what we're looking at. But I think a world where job creation is negative, I just think we need to watch that situation very carefully and be in a position where we're not, pushing down on job creation with our policy.
when we're talking about supply, we have seen major American employers like Amazon cite AI in job cuts. How much right now are you factoring in AI into the current weakness in the job market?
So it's probably part of the story. It's not a big part of the story yet. We don't know whether it will be. But, for example, if you look at, you can't miss the big announcements of layoffs and also companies saying that they're not going to hire anybody for a long time, and they cite AI. That's all clearly happening. At the same time, people are not filing for unemployment insurance. And since job creation, job finding rates are extremely low, if there were big numbers of layoffs, you'd expect the continuing claims to go up, and you expect new claims to go up. It really haven't much. So it's a little bit curious. But longer term, though, the question is, what are we going to see here? And we don't know, but it's it may be that in past technology, really significant technology innovation eras, you have seen some jobs destroyed and other jobs made. Ultimately, what's happened for a couple hundred years is when you get through all that, you have higher productivity and you have new jobs, and there are enough jobs for people. This may be different. It's every time we have a wave of technology, we think, oh, this could put a lot of people out of work. What are they going to do? In the past, there's always been more work and higher productivity, and incomes have risen. What will happen here, we're going to have to see. But right now is such early days. We don't think we see much. It's certainly not showing up in layoffs yet.
Thank you, Chair. And the current Bloomberg News. Given the breadth of views on the policy committee, why is there such a division of views between
the policy what?
On the committee?
Thank you.
Why is there such a division of views between the presidents and the board members?
It's not so stark as that. There's depth. The views are more varied in each group as well. There's some of that, but I would say they're also governors and they're people on both sides in both groups. I wouldn't put too much in that.
Okay, and just to follow up, please, given your growth upgrade, how would you factor in, or what would be the economic impact if the Supreme Court is to strike down the tariffs that they're currently hearing, please, in terms of growth and inflation? Thank you.
I really don't know. It would depend. It would depend on a whole bunch of things we don't know. So I can't really help you there.
Christine.
Thank you, Chair Powell. Christine Romans, NBC News. I wanted to ask you about how the higher income households are really driving spending right now. They're backed by home equity and stock market wealth. The lower income consumers are really struggling with the accumulation of 5 years now of rising prices. It's price levels, not really the inflation rate, holding some of these families back. How sustainable is this so-called K-shaped economy? And what are the Fed's thoughts on whether that's a risk going forward?
So we do, through our vast network of contacts and just through our observation of what's going on in the economy, we hear about this a lot. If you listen to the earnings reports for consumer-facing companies that tend to deal with low and moderate income people, they'll all say that we're seeing people, tightening their belts, changing products that they buy, buying less, and that sort of thing. And so it's clearly a thing. It's also clearly a thing that asset values, housing values, and securities values are high, and they tend to be owned by people more at the higher end of the income and wealth. So as how sustainable it is, I don't know. Most of the consumption does happen by people who have more means. I think, the top third accounts for way more than a third of the consumption, for example. So it's a good question how sustainable that is. The best we can do is to have a, price stability and a strong labor market. What we saw, for example, what we saw at the end of the very, very long expansion that ended with the outbreak of the pandemic, we saw that it was 10 years and 8 months or something like that, the longest one in recorded history. In the last 2 years, most of the largest part of the wage gains were going to people in the bottom quartile, the bottom part of the low and moderate income. So, having a strong labor market for a long period of time is really, really good from a social standpoint. It's helping people at the lower income levels, and that's what we all want to get back to. But we got to have price stability, and we got to have full employment, maximum employment.
And just quickly, you mentioned the housing market remains kind of weak. With these rate cuts that we've seen, is there a chance we're going to see more affordability in the housing market so more people can maybe enjoy that part of wealth creation? I mean, the average age or median age of a first-time homebuyer is now 40 years old. That's the highest on record.
Yeah, so the housing market faces some really significant challenges. And I don't know that, a 25 basis point decline in the federal funds rate is going to make much of a difference for people. Housing supply is low. Many people have very, very low rate mortgages from the pandemic period, and they kept refinancing and caught the really low. So it's being expensive for them to move. And, we're a ways away from that changing. Also, we haven't built enough housing in the country for a long time. And so a lot of estimates suggest that we just need more housing of different kinds. So housing is going to be a problem, and really the tools to address it are we can raise and lower interest rates, but we don't really have the tools to address a secular housing shortage, a structural housing shortage.
Chris.
Thanks, Chris Rugaber, Associated Press. You mentioned on inflation, services inflation being low, goods inflation looking like maybe it'll peak. We had the wages report you mentioned today showing moderating wage growth. Where are the inflation risks? It looks like inflation is cooling in your view. At the same time, you have potentially negative hiring. Why not? Why aren't we hearing more about maybe more cuts in this environment?
Well, I think the risk inflation is pretty clear to see, and that is, we see higher inflation. As I mentioned, most of the inflation over target is from goods, and we estimate, we expect, most of us, that inflation will be a one-time price increase and then come down. We just came off an experience where inflation turned out to be much more persistent than anyone had expected. Is that going to happen now? That's the risk. The risk is either that tariff inflation just turns out to be more and more persistent, maybe because companies who are now holding back from passing through the tariffs will just keep doing that. So you see that. I think the other possibility is less likely, and that is just that the labor market gets tight or the economy gets tight, and you see just traditional inflation. I don't see that as particularly likely. But so I think again all across the committee, people see the picture pretty similarly, but see the risks quite differently. And some people do see the inflation risk, and I wouldn't dismiss that case. I don't dismiss that case, but you gotta make an assessment, and this is the assessment we made.
Hi, Chair Powell, Neil Irwin with Axios. So this has come up a couple of times today, but to be clear, do you believe that we're experiencing a positive productivity shock, whether from AI or policy factors or whatever? And how much is that driving the higher GDP projection in the SEP?
So yeah, I never thought I would see a time when we had 5-6 years of 2% productivity growth. This is higher. This is definitely higher, and it was before it could be attributed to AI. I also think if you look at what AI can do, and if you use it in your personal life, as I imagine many of us have, you can see the prospects for productivity. I think it makes people who use it more productive. It may make other people have to find other jobs. So it could have productivity implications while also having social and labor market implications that we don't have the tools to deal with. But yes, I think we're definitely seeing higher productivity. I think it's a little quick to be saying it's generative AI, but I don't know. The pandemic may have induced people to do more automation and do more things with computers to replace people, and that raises productivity, output per hour.
Does that imply a higher neutral rate, and therefore the policy might be a little easier than it seems?
all things equal, yes, but all things aren't equal. There are many things pushing in different directions on where the neutral rate would be. But yes, that argument does come up.
Matt Egan.
Thanks, Chair Powell. Matt Egan with CNN. After today, you only have 3 more meetings at the helm of the Fed. Since becoming Fed chair, you've seen multiple trade wars, the pandemic, COVID reopening, period of high inflation. I know your term's not up as chair until May, but I'm wondering if you've given any thought to what you want your legacy to be.
My legacy. My thought is that I really want to turn this job over to whoever replaces me with the economy in really good shape. That's what I want to do. I want inflation to be under control, coming back down to 2%, and I want the labor market to be strong. That's what I want. And all of my efforts are to get to that place. They have been all along, but ultimately, that's what I'm. And it's I don't have time to think about the bigger things. I hope many years ahead to worry about that, but there's enough to do.
Relatedly, have you given any more thought, and can you tell us any more about your plans on whether or not you plan to stay on the Fed Board of Governors even after your term as chair expires?
Again, I'm focused on my remaining time as chair. I haven't got anything new on that to tell you.
Go to Mark for the last question.
Chairman Mark Hamrick with Bankrate. Even while many price levels remain elevated, the reductions in the federal funds rate means that savings rates or yields, to be more precise, have peaked, while key borrowing rates remain elevated. And that's, as we've discussed here, as many Americans struggle with liquidity or emergency savings challenges. Is that just collateral damage or an unintended consequence because your tools are limited in addressing individual or household liquidity constraints, insufficient money in the bank?
I don't know. I wouldn't agree that that's collateral damage of our. I mean, over time, we do what we do in order to create price stability and maximum employment, and those things are hugely valuable to all the people we serve. When we raise rates to bring inflation down, that does work by slowing the economy. But we've moved back our policy back down to where it's not. It's certainly not strongly restrictive at this point. I think it's sort of in the range of neutral. So that's what we're trying to do, and I would want people to understand that. I think what people are feeling is the effect of higher prices. There was a global wave. Sort of every large economy in the world, sort of every large open economy, market-based economy in the world had a wave of inflation that looked an awful lot like ours. We actually came through better than any other country, substantially better. We had higher growth, we had better labor market, and this is really due to the American economy. We have an extraordinary economy, and people are innovative, they work hard, and so all of us who work in economics jobs are really fortunate to have the U.S. economy. So, thank you very much.
This is the Fed Decides on Bloomberg Television and Radio. Fed Chair Jay Powell wrapping up his news conference.
All right, guys. Powell is gone. Look at the chart here. Dimitro,
Yeah, some crazy moves. Yeah, I see. Oh my God.
Yeah. Look at this. Just Bitcoin has awakened and it just pumped up, and we reach our BSL, the swing high, the buy side liquidity from the smart money indicator, and now we are going down again.
Yeah,
So
but I need to mention we didn't grab the liquidity from this buy side liquidity, yeah. So we didn't reach, the target, but we were very close to that. And can we see in percent, Rafa, this move?
Yeah, for sure. It's like you want to take it from here.
Yeah. Would be really
It'd
interesting.
be like 1.66%.
Okay, so almost 2%, yeah, something.
Almost 2% in 10 minutes, yeah. And as you say, we reach we got very close to the BSL, and now the price is just dropping back. But at least you see how powerful and useful is our indicator, because it was it was a really nice catch here. So we are going back to the fair value gap, and looks like now the price is stuck again between 93 and 94. What do you think, Dimitro?
Yeah. So I think we need one more Powell speech, and we can break that 95K level.
Yeah, wait for next year. So I just noticed that at the end, one participant asked Powell what is his plan after go away from the Fed, and he said he doesn't know anything, and so there is no plan yet. And let's see if there is there will be the new chair that will
New
be
Powell.
closer to Trump. Yeah, is closer to Trump governance. So yeah, I mean, Powell just keeps saying, and he said the same thing as last time. So inflation is still a bit high, labor market is weak, and there are some struggle on liquidity, but he has to manage both parts. So this is the only thing he can do. So let's see for the next meeting. And yeah, now looks like Bitcoin is stabilizing.
Yeah. So now we can start trading, because in this spot when Powell is talking, it's really markets got so many manipulation actually in this minutes, hours. So yeah.
Yeah, you're right. So you just like 2% pump in 10 minutes and then retracement immediately. So better to wait tomorrow for a
even
good
tomorrow.
trade. Now it's too hard time. Yeah. Anyways, thanks Dimitro, and thanks everyone for this. Yeah, thanks everyone for this special live, and see you back tomorrow for our usual quick scan session. Thanks, Soda. Thanks.
Yeah, Soda.
I know there is a scam comment from Twitch.
Thanks, David.
Thanks, David. Thanks, everyone, for joining this time with me and Dimitro. And yeah, see you next time.
See you guys. Bye-bye.
Bye.